Hello everyone, Luke McElfresh here. In today's video, I will be working through some practice problems from Chapter 13, which is titled Return, Risk, and the Security Market Line. So in Chapter 12, we went through some lessons from capital market history, and we looked at historical returns of different asset classes, and we calculated historical variance and also historical standard deviation, and assessed how these measures of volatility affect the expected return on these different securities. In Chapter 13, we turn our attention towards expected returns in the future, and we also dive into expected returns on individual securities based on their level of risk using what is called the capital asset pricing model. So let's just jump into practice problem number 1 here and start to evaluate expected returns for future upcoming returns. So based on the following information, calculate the expected return and standard deviation of the two stocks. So you can see that we have stock A and we have stock B, and we also have some different probabilities of different states occurring, whether it be a recession, a normal economy, or a boom economy. So the expected return of an asset is the sum of each return times the probability of that return occurring. So let's first calculate the expected return of asset A, or stock A in this particular case. So calculating the expected return of a stock when we know different probabilities of the economy is relatively straightforward. There is a 15% chance of a recession occurring, and in the event that there is a recession, stock A would provide a 4% return. We then add to that the probability of a normal economy occurring and the 9% return that stock A would generate in that economic condition, and then we add to that the probability of a boom economy occurring and multiplying it by the 17% return that stock A would provide during that type of economic condition, and we would end up getting an expected return of stock A that is equal to 0.1065 or 10.65%. So essentially what we're doing is we're weighting the returns based on the probabilities of different economic states occurring. So this is our first part, calculating the expected return of each of these two stocks. Let's go ahead and calculate the expected return of stock B. So once again, there is a 15% probability of a recession occurring. In the event of a recession, stock B would provide a negative 17% return. There is a 55% probability of a normal economy, where in that economic condition, stock B would provide a 12% return, and then there is a 30% probability of a boom economy, and in that economy, stock B would provide a 27% return. We do these calculations and we get an expected return of stock B, weighting the different probabilities of the different economic events or economic conditions to be 0.1215 or 12.15%. So that was our first step, is to calculate the expected return, and hopefully you realized from the last chapter that in order to calculate the standard deviation, we first must need the variance. So to find the variance, we find the squared deviations from the expected return that we just calculated. After we find the squared deviations from the expected return, we will then multiply each possible squared deviation by its probability and add all of these up. So as you should remember from the last chapter, we signify or represent variance with sigma squared. And the first one that we are going to do is calculate the variance of stock A. So there is a 15% probability of a recession. In a recession, stock A would provide a 4% return minus their expected return of 0.1065, and we square that. Add to it the probability of a normal economy, the return in a normal economy of 9% minus the expected return that we calculated in the first part of 10.65%. We square it, and then we add to it the probability of a boom economy and the 17% return minus the expected return for the asset as a whole, and we square that as well. So if you remember from the last chapter, we say that variance is the sum of the squared deviations from the mean. We are pretty much doing the exact same thing here, except we're not dividing by n-1. We are still identifying the sum of the squared deviations from the mean, but instead of dividing by n-1, when we multiply by the different states of the economy, we can calculate the variance for a future outcome, in this case the return of stock A in different economic conditions. So when I go ahead and calculate this variance, I get a value of 0.00202. If you remember from the last chapter, variance does not have any units attached to it, and so then when I find the standard deviation, which is represented by sigma of stock A, I just take the square root of the variance of 0.00202, and so the standard deviation would end up being 0.0450 or 4.50%. Keep in mind that standard deviation has the same units of measurement as whatever the inputs are. In this case, we are dealing with a return of a stock. So now let's apply the same methodology to stock B and calculate its variance. So we first take the probability of a recession, which is 15%. And then if you weren't sure, I'm getting these values from what the expected return would be in these different economic conditions, and then also the expected return that we calculated in Part A. You can think of the expected return as the average return that we used in the last chapter when we were dealing with historical variance and standard deviation. However, in this chapter we are dealing with future returns, so we have to use the information that's provided. Here we have a 15% probability of a recession. In a recession, stock B would generate a negative 17% return, and the average then was a 0.1215% return. We square that value. Notice that we are finding the difference from the mean, so we subtract the difference from the expected return, so we subtract that 12.15%, even though our expected return in that time period is still negative. We would add to this the probability of a normal economy, which is 55%. Take its return in that condition of 12% minus the 12.15% expected return for the asset or for the stock as a whole, and we square that value, and then hopefully you're realizing that we would take the probability of a boom economy, multiply it by the difference between its return and the expected return, and we square that value. Once again, we don't divide by n-1 in these conditions because when we multiply by the probabilities, we are taking into consideration that these are future returns, not historical returns like in the last chapter when we calculated historical variance. So I guess just to be consistent with how I have everything going horizontally, the variance here would end up being 0.01936. Again, no units attached to that. When I calculate the standard deviation of stock B, so the sigma of stock B, I'll take the square root of that variance, 0.01936, and I end up getting a standard deviation of 0.1392 or 13.92%. So hopefully you remember that variance and standard deviation in particular measure the volatility and riskiness of a particular security. So here with stock B, we have a much higher standard deviation. We could say that stock B is more risky and should also provide a higher return since we are taking on the additional risk. And from Chapter 12, you should remember the risk-return trade-off. Additional risk requires an additional risk premium and a higher return. So let's move on to number 2. So number 2 says consider the following information. Once again, we have two economic conditions, the probability of those conditions, and now we have a portfolio. So we have a rate of return of different stakes or different stocks in these two conditions, and they want to know what is the expected return on an equally weighted portfolio of these three stocks. So to find the expected return of the portfolio, we need to find the return of the portfolio in each state of the economy. Then what we will end up doing is sum the returns of each asset and divide by the number of assets so that the return of the portfolio in each state is represented as such. So here we have a boom economy. In a boom economy, the return of the portfolio would be a 6% return from stock A, a 15% return in stock B, and a 25% return of stock C. Divide by 3 since we have 3 different stocks that are equally weighted. This is a very unique situation because, not very unique, but is a unique situation in terms of how we calculate the return of the portfolio because they are equally weighted. You'll see what happens in Part B when we have a different weight associated with each stock. And so the expected return in a boom economy would be 0.1533 or 15.33%. And then we want to do the same thing, but now in a bust economy. So what is the return of the portfolio if this economic condition occurs? It would be an 11% return in stock A, a negative 4% return of stock B, and a negative 8% return of stock C. Once again, equally weighted, so we can just divide by 3, and I would have a negative 0.00338 or a negative 0.338% return in a bust economy. So all we've done right now is calculated the expected return in condition A, a boom, condition B, a bust. Now we need to take into consideration the probability of those two events occurring. So the expected return of the portfolio, there is a 75% chance of a boom economy. In this economy, the portfolio would generate a 15.33% return from part A here, or our first steps here in question A, plus the probability of a bust economy, which would be 25%, and its return of negative 0.338. We sum these products together, and we would get an expected return of the portfolio of 0.1142, or 11.42%. So what we do is we calculate the expected return of each or of the portfolio within each state, and then we multiply these states by the probability of those economic conditions to get the expected return of the portfolio as a whole. So now we have a little bit different here for part B. So part B, we'll go ahead and start solving here in red. What is the variance of the portfolio if it's expected, or if we invested 20% in stock A, 20% in stock B, and then 60% in stock C? So once again, we do want to calculate what the expected return of the portfolio is overall, and then we can go ahead and calculate variance. We need to know the expected return before we can solve for variance, just like we needed to know the average return before we could solve for variance in the previous chapter. So the first thing that we need to do is let's figure out what would be my return in a boom economy if I have a 20% investment in stocks A and B, and then a 60% investment in stock C. So previously, in part A, we just added up and divided by 3 since it was equally weighted. But in this scenario, 20% of my portfolio is in stock A, and in a boom economy, stock A would generate a 6% return. We add to that the 20% breakdown of the portfolio in stock B and its return in this boom economy, and then the 25% or the 60%. The 60% portfolio weight of stock C and its 25% return in a boom economy, and we end up getting a return of the portfolio in this boom situation of 0.1920 or 19.20%. We'll do the same thought process for part B, or for the bust economy. Again, 20% of our portfolio is in stock A, and in a bust economy, stock A will generate an 11% return. In a bust economy, stock B will generate a negative 4% return. And then once again, 60% of our portfolio is in stock C, and in stock C, bust economy would generate a negative 8% return. And so we end up getting an expected return of the portfolio in a bust economy that is equal to negative 0.0340 or a negative 3.40% return. So in the event that we were to have a bust economy, the portfolio as a whole would end up having a negative return. Now, this is not the expected return of the portfolio. These are just the expected returns under each of these two economic conditions. To calculate the expected return of the portfolio, we need to assign the different probabilities of these states occurring. So there is a 75% chance of a boom economy. In the event of a boom economy, the portfolio will generate a 19.2% return from the previous step. And then the 25% of a bust economy, where the return would be a negative 3.4%. So the expected return of the portfolio, considering the probabilities of these two economic conditions, is 0.1355 or 13.55%. Now, that is not what the question is asking. We still need to calculate what the variance is. So to find the variance, we find the squared deviations from the expected return that we just calculated, and then we multiply each possible squared deviation by its probability, and then add all of these up. So to calculate the variance, sigma squared, of the portfolio, there is a 75% chance of a boom economy. We take the expected return in a boom economy of 0.1920. That's coming from up here in our expected return in this economy, minus the expected return of the portfolio as a whole. And we square this, and then we sum to it the probability of a bust economy, its return of a negative 0.0340 minus the expected return of the portfolio as a whole. And we square that value, and we end up getting a variance of 0.009577. So I realize that this problem does not have you calculate the standard deviation, but we could very easily do this. And so the variance of the standard deviation of this, just taking the square root of this variance figure, would give me a standard deviation of 0.097862 or 9.7862%. That would be the variance that we were looking for in part B of that problem. Okay, so what we have now been able to do is calculate the expected return of individual assets under different economic conditions, and also use this information to calculate variance and standard deviation. And then we were also able to take a portfolio, where in this case our portfolio only consisted of 3 stocks, and calculate the expected return of the portfolio under different economic conditions, and also assess the variability or the riskiness of these portfolios by calculating variance and standard deviation. Okay, so in this third problem, once again, we have a portfolio consisting of 3 different stocks. The difference with this problem in comparison to the last is that now we have 3 different states of the economy. So in this problem, we have invested 40% in stock A and 40% in stock B, and then we have a 20% investment or portfolio weight in stock C. Let me just clear this out so we can actually read these values. So 40% in stock A, 40% in stock B, and 20% in stock C. First thing that they want is the expected return, and then we also need the variance and the standard deviation. So before we start to apply the probability of a boom, a normal, or a bust economy, let's calculate what our returns would be in the event that each of these economies occur. So in a boom economy, our portfolio is 40% stock A, in which the return would be 21%. Our portfolio is 40% stock B, in which the return would be 36%. And then we have 20% in stock C, in which its return would be 55%. The return of the portfolio, which we can signify by R subletter P, would be 0.3380 or 33.80%. And now let's do the same methodology for normal and bust economy. The weights don't change. The returns of the individual securities do change. So still 40% for stocks A and B, but in a normal economy, stock A will only generate a 17% return, stock B a 13% return, 20% weight for stock C, and it's 9% return. If a boom economy occurs, the return of the portfolio would be 1.1380 or 13.80%. And then one more step. With the bust economy, the return of the portfolio, hopefully you're understanding that the weights are not changing. This weight stock A would actually provide a 0% return in the event of a bust economy. Stock B will generate a negative 28% return, and then stock C and its 20% weight would generate a negative 45% return, and you get negative 0.2020 or a negative 20.20%. So notice that we have not yet utilized the states of these different economies occurring. Now what we do is we apply these probabilities to these expected returns to calculate the expected return of the portfolio as a whole. So there is a 25% possibility of a boom economy occurring. In the event that that occurs, the portfolio will generate a 0.3380% return, so a 33.80% return. We add to that the probability of a normal economy multiplied by its expected return in the event of a normal economy. And then we add to that the probability of a bust economy times its expected return, which is a negative 0.2020. And we would get an overall expected return of the portfolio equal to 0.1370 or 13.70%. So now, to calculate the standard deviation, we would first need to calculate the variance. Once again, the variance is the squared deviations from the expected return, and we multiply that by the different probabilities of these different events occurring. So let's calculate the variance of the portfolio, a 25% probability of a boom economy. In a boom economy, we're going to be utilizing these values in comparison to the expected return overall. So in a boom economy, it would be a 33.80% return minus the expected return of the portfolio as a whole. Once again, we square this. The squaring ensures that all of our final outputs are positive when we're calculating variance. We're really just trying to see how close our inputs are to the average or the expected return in this case. 0.6% probability of a normal economy. In a normal economy, it would be a 13.8% return. So we take that value and subtract the expected return of the portfolio as a whole and square it once again. And then a 15% probability of a bust economy and its 20.20 negative return minus the 0.1370% expected return, and we square that value. So when I do these calculations, I end up getting a variance of the portfolio that is equal to 0.02734. Once again, that does not have any units. To find the standard deviation, we take the square root of this variance value, which will end up giving me a standard deviation of 0.1653 or 16.53%. Now, part B then deals with this risk premium. So it says if the expected T-bill rate is 3.8%, what is the expected risk premium on the portfolio? Well, hopefully you remember from the last chapter that the risk premium is the additional risk that an investor requires to take on some additional risk. Well, that would be the difference between the expected return on that risky asset minus the risk-free rate. Well, the risk-free rate is provided as the treasury bill rate, and so to calculate the risk premium, it is simply equal to the expected return of the portfolio minus the risk-free rate. So what we end up having is the expected return of the portfolio, which was 0.1370, which is what we calculated up there in part A is the expected return of the portfolio, minus the risk-free rate of 3.8%, the treasury bill rate. So we end up getting a risk premium, and I guess I could do risk premium of the portfolio. Notation is getting a little funky, but we end up getting 0.0990 or 9.90%. So we require almost a 10% premium to invest in a risky portfolio such as this one comprised of A, B, and C stocks over in excess of what the treasury bill rate is for this particular time period. Okay. Moving on, now we are dealing with an individual stock and what its expected return can be based on the amount of systematic risk that that particular stock has. So if you've read the chapter, you realize that we can diversify unsystematic risk away. Systematic risk is the risk of a particular security that cannot be diversified away. And one way that we can measure the amount of systematic risk that a stock has is by looking at the beta of that particular stock. And then when we use the capital asset pricing model, we can calculate the expected return of a stock based on the market risk premium, the beta of that stock, and also what the risk-free rate is. So in this problem, a stock has an expected return of 10.2%. We have a risk-free rate, so that would be your treasury bill rate, and the market risk premium is 7.2%. What must the beta of this stock be? So we're given the values for CAPM except for the beta of the stock. So if we substitute these values into the capital asset pricing model, we can then solve for the beta of this stock. One thing that we must keep in mind is that we are actually given the market risk premium, which is the expected return on the market minus the risk-free rate. So in regards to your capital asset pricing model, that is not something that we need to actually calculate. There's a difference between given the market risk premium and given the expected return of the market. So keep that in mind that when you are using the CAPM, the capital asset pricing model, it is the risk-free rate plus the market risk premium, which we then multiply by the beta of the security that we're analyzing. So in this case, they say that we have a risk-free rate of well, this would be the expected return. So this is your capital asset pricing model. We have the expected return, and that is equal to 10.2%. The risk-free rate is 4.1%. They tell me that the market risk premium, this entire parenthesis there, is 7.2%. And we are solving for the beta. So if I subtract 0.041 from both sides and then divide by 0.072, you would end up getting a beta for this stock that is equal to 0.85. So this has less systematic risk than the market as a whole, as we compare our beta values to 1. Greater than 1 would have more systematic risk, less than 1 would have less systematic risk. So hopefully, as you look at stock, or at number 5 here, when it says a stock has an expected return of 11.05%, a beta, the risk-free rate, and they want to know what is the expected return on the market, you realize that we have all the necessary values to utilize CAPM, except for solving for the expected market return. So what we have is the expected return on a particular stock is equal to the risk-free rate plus the market risk premium, which is the expected return on the market minus the risk-free rate multiplied by the beta of that security. So the expected return of the stock is 0.1105, that is given. The risk-free rate for Treasury bills is 3.6%. They want us to solve for the expected return on the market. They tell us that the risk-free rate is 0.036, and then the beta is 1.13. So this stock has more systematic risk than the market as a whole. When I solve for the expected return on the market by utilizing some algebra, subtracting 0.036 from both sides, and then dividing by 1.13, the beta, and then adding 0.036, I end up getting an expected return on the market that's equal to 0.1019, or 10.19%. So this concludes the practice problems from Chapter 13, where we are solving for the expected return and variance and standard deviation for future returns based on different probabilities of different economic events. So we are not utilizing historic returns to calculate the riskiness of these securities, rather probabilities of future events occurring. And then we also did a few calculations utilizing the capital asset pricing model, which provides an expected return on a stock based on the amount of systematic risk that stock has, and also the expected return on the market in comparison to the risk-free rate and also the risk-free rate by itself. So I hope you enjoyed this video. Hopefully it helps with this week's assignments. If you have any questions about anything, please don't hesitate to contact me, and I'll talk to you all soon.